If you're an American investor looking for the best index funds for long-term wealth, the name Fidelity is probably already on your radar. Their offerings are some of the most trusted and cheapest ways to invest in the U.S. economy. But with dozens of funds to choose from, how do you know which ones are truly the best Fidelity funds for your money right now? I've broken down and updated the performance of the 5 most powerful Fidelity index funds that consistently beat inflation and put your portfolio on the path to financial freedom. We're going beyond the basics to look at which funds deliver the fastest growth, the highest dividends, and the most stability, all updated with the latest 2025 performance data. Let's get into it. Starting at number 5 is the fund built on the simplest, most time-tested idea in investing: owning the best of corporate America. We're talking about the Fidelity 500 Index Fund, ticker symbol FXAIX. When you buy FXAIX, you are buying into the 500 largest publicly traded companies in the United States. It doesn't try to beat the market. It is the market. This fund represents the businesses that power the economy every single day. FXAIX manages over $722 billion in assets, making it one of the largest mutual funds on the planet. It holds over 500 stocks with exposure across every sector. When one part of the economy slows down, another usually picks up. Its top 10 holdings include the true backbone of modern growth: Nvidia, 7.97% weight, Microsoft, 6.74% weight, and Apple, 6.62% weight. The secret sauce for this and many of the best Fidelity funds is efficiency. The expense ratio is just 0.02%, or even 0.015% in the latest data, meaning you pay only pennies a year for every $1,000 invested. Over the past 5 years, FXAIX has delivered a $10,000 investment growth to over $39,000. Its year-to-date performance for 2025 sits at an impressive 14.46%. While it isn't designed for large dividend checks, its current yield is 1.11%, and the real power is the long-term price appreciation. It's a core holding for a reason. What if you could expand beyond the top 500 companies to own every single company in the U.S. market, and do it with absolutely zero fees? That's the promise of the Fidelity Zero Total Market Index Fund, ticker symbol FZROX, the true zero-cost diversification. Unlike the S&P 500 funds, FZROX holds thousands of companies, from massive tech giants to mid-sized and smaller businesses. It's not just a slice of the market, it's the whole pie. The expense ratio is a true 0%. Every dollar you invest stays in your portfolio, compounding year after year without management fees. The fund holds around 2,551 equity holdings and 2,578 total holdings, offering broad diversification. The top 10 holdings, led by Nvidia, 7.02%, Apple, 6.06%, Microsoft, 5.81%, and others, make up about 34% of the fund, giving you stability from big names and extra upside from the rest of the U.S. economy. The total market approach is why many consider this one of the best Fidelity index funds. FZROX has delivered a 5-year return of around 91.67%, only slightly behind the S&P 500, with a YTD return of 14.43%. It has slightly higher volatility than S&P 500 funds because it includes smaller companies, but this extra movement often becomes an advantage during expansions when mid and small caps grow faster than the large ones. FZROX offers a 1.1% dividend yield, and that payout is backed by a 5-year annualized dividend growth rate of 7.55%, a growth rate that outpaces inflation. Next, at number 3, we hit the sweet spot of the U.S. economy: the Fidelity Mid-Cap Index Fund, ticker symbol FSMDX. This fund focuses on companies right in the middle, not the massive names like Apple, but not the tiny startups either. These are businesses that have proven themselves but still have plenty of room to grow. Historically, mid-cap stocks have been shown to outperform both small and large caps over long periods of time. Pure mid-cap focus, FSMDX holds around 816 stocks, and the top 10 holdings make up only about 6% of the fund, meaning no single company dominates. You'll find names like Royal Caribbean, Cloudflare, and Howmet Aerospace, companies that may not make daily headlines but continue to grow and reward patient investors. The expense ratio is only 0.025%, keeping it one of the most affordable mid-cap options available. While its 5-year performance of 12.33% or a YTD return of 10.39% is slower than the tech-heavy funds, this one makes up for it in one key area: The dividend yield sits around 1.25%, reasonably better than most broad-market Fidelity index funds. We've covered the rock-solid foundation funds, the S&P 500, the zero total market, and the high-dividend mid-cap fund. But the final two funds on this list are for investors seeking something more: exponential growth and alignment with the biggest disruption trends in the U.S. market. These next two funds have a stronger focus on the innovative sectors and have historically delivered some of the fastest share price appreciation available. After we cover the next two picks, I'll walk you through a quick check to ensure your current portfolio is properly positioned to capture these opportunities. The fund at number 2 is built for investors who want to align their money with the future, not just the past. The Fidelity U.S. Sustainability Index Fund, ticker symbol FITLX. This fund is designed to invest in companies that lead responsibly, meeting high standards for environmental, social, and governance (ESG) practices. This isn't a sacrifice play. The companies that check all the ESG boxes are often giants in their sectors. The fund holds around 276 companies and leans into sectors positioned for long-term strength: clean energy, advanced technology, healthcare innovation, and digital infrastructure. The top 10 holdings include innovators like Nvidia, Microsoft, Alphabet, Tesla, Visa, and MasterCard. FITLX completely breaks the stereotype of a slow-moving sustainability fund. Over the past 5 years, FITLX has returned about 15.68% annually. Its YTD performance in 2025 is 14.42%. The global shift toward clean energy, digital transformation, and responsible business isn't slowing down, it's accelerating. This fund sits right at the center of that movement. While its dividend yield is modest at about 1.1%, its dividend growth rate over the past 5 years has been a strong 13.74%. The final fund on our list is for pure, unadulterated growth. This is where you put your money when you believe in the future of technology. The Fidelity Nasdaq Composite Index Fund, ticker symbol FNCMX. This fund isn't built for safety or predictability. It's built simply for growth. When you invest in FNCMX, you're buying into the heart of technological progress, the companies creating the products, platforms, and systems that shape the way we live and work. Deep tech concentration. The fund tracks the Nasdaq Composite Index, which includes more than 2,800 companies dominated by the world's most influential disruptors. The top 10 holdings make up over 60% of the portfolio, giving it a very strong focus on the biggest tech giants. Over the past 5 years, this fund has delivered an annualized return of 16.16%. But the recent performance is truly stellar. Its year-to-date return for 2025 is 17.92%. Look at the 10-year chart, and you'll see returns of over 340%. This fund's performance comes with a key trade-off: volatility. Because FNCMX is heavily concentrated in technology, it tends to soar during bull markets but takes harder hits when the economy slows down. Its short-term moves are far sharper than safer funds like FXAIX or FZROX. Like most high-growth stocks, this fund is not about dividends. Its dividend yield is low, around 0.5%. The companies in the fund reinvest their profits into innovation and expansion, driving incredible price appreciation. The current price of FNCMX sits near $293.51, and the fund remains one of the best Fidelity funds for aggressive, long-term investors looking to capture the tech boom. We've broken down 5 of the best Fidelity index funds, from rock-solid foundations to explosive growth engines. If you found this valuable, consider subscribing to the channel and share it with whoever needs it. The key takeaway, regardless of which of these funds you choose, is to always follow data over emotion.